Hello, scholars. This is Dr. Jepkorir Barus from Kenya, Baringo County. I really want to thank SciTech Conference for inviting me as a speaker to this virtual conference during COVID-19 in Thailand, Bangkok. Today, I'm going to present the effect of liquidity on financial performance of savings and credit societies in Kenya. As an introduction, the World Cooperative Movement was initiated in the year 1844 in Rochdale Village, Manchester in England. Since then, it has spread globally as a social economic movement with its unique identity, history, and objective. In 1864, the first credit union was established by Raiffeisen in Germany to facilitate the need of rural people, which were deemed non-bankable owing to very few fluctuating cash and shortage of human capital, according to Warsaw 2008. In Africa, research indicates that approximately 7% of the African population is affiliated to cooperative sector. Also, specific social protection mechanisms associated with cooperative in Africa are very limited. That's according to Paulette 2009. Growth of Africa was experienced to the extent that in 1965, a COSCA was formed with the principal objective of offering SACCOs, insurance, education, members, promotions, SACCO principles. That is according to Ngombe and Mwikaba 2004. There are 28 countries in the continent of Africa with established SACCOs with membership of 16 million, which is approximately 8% of the whole world membership, with savings of 62% and loans of 65%, being third after Asia and North America, which has 36 million and 102 million respectively. Africa mobilized 0.4 of the world savings credit of US dollars 1.1 trillion and 0.1 of international loans given to members, standing at US dollar 912 billion. That's according to Warsaw. In East Africa, the East African Legislative Assembly passed the East African Community Cooperative Society Bill in 2014 to provide a legal framework for cooperative societies in the community and to provide for other related matters encompassing rights and duties of members, organs of cooperative societies, assets and funds for societies, audit and inspection, and miscellaneous provision. That is according to East Africa Cooperative Society Act 2014. In Ethiopia, Zivaseshwa 2010 investigated the determinants of SACCO performance. The study established that education level of members and officials, as well as regulation, posed the highest impediment to the performance of SACCOs. And then in Kenya, the first SACCO, Lumbwa SACCO, was established by white settlers in 1908 with the main aim of enhancing agricultural activities in order to take advantage of the economic of scale, according to Cusco. The SACCO was formed to enable the members bargain for better utilization and seed prices. That's according to Chebor 2008. At the beginning of 2011, there were 83 deposit-taking SACCOs that had complied and registered with SASRA, that is SACCO Regulatory Authority. By 2016, there were a total of 245 SACCOs, out of which a total of 164 SACCOs were licensed for deposit-taking business. The remaining 81 deposit-taking SACCOs were required by law to have achieved the minimum licensing threshold, and 83 were had audited published accounts from 2011 to 2015. Problem statement. The SACCO sector remains a significant player in provision of financial services to the Kenya household and small business segment. Its membership as per 2013 increased to 3.3 million from 2.97 million in 2012. SACCOs played a vital role for pooling resources for investment and wealth creation. That's according to Nyua 2013. They spur economic growth through mobilization of domestic savings. According to Sasra report, SACCOs activity contribute to 43% of GDP in Kenya. The significance of SACCOs to Kenyan economy is further evidenced by inclusion in the Vision 2030. That's according to Kyoko 2014. Given their significance in the financial sector and poverty alleviation, it is important to investigate the effect of liquidity on financial performance in order to provide accurate and consistent assessment of financial performance of savings and credit societies, financial conditions and operation in the area of performance. Zivaseshwa 2010 investigated the determinants of SACCOs performance in Ethiopia. Sonja 2010 analyzed SACCOs in Uganda to determine the effects of automation on the growth of SACCOs. Based on these studies and the varying gaps in literature, there is need to conduct similar studies in Africa and more so in Kenya. Therefore, this research attempt to determine the effects of liquidity on financial performance of savings and credit societies in Kenya. The objective of this study was to determine the effects of liquidity on financial performance of savings and credit societies in Kenya. Then the hypothesis was liquidity had no statistical significant effect on financial performance of SACCOs in Kenya. Literature review. We have liquidity theory that was developed by Keynes in 1936. In his famous book, The General Theory of Employment, Interest, Money, this was due to Great Depression, which with persistent unemployment, for which the quality theory of money has no answer to economic problems in the society. Jihang 2004. This theory is based on the preposition that money is the financial asset in portfolio that consists of either money or bond. He further researched on both transactional and asset theories of money demand. Keynes distinguished three motives of holding money as transactional motive, precautionary motive, and speculative motive. Baumol and Tobel, 1958, defined the liquidity preference theory and their preposition, which was based on Keynesian model economy that is established on investing in risky assets instead of transactional balances. William Baumol considered transactional balance to meet the working capital needs for investors, while Tobin emphasized on investment balance that promised on liquidity preference theory that seeks to explain the level of interest rates with regard to interaction of money supply and desire of savers to hold their savings in cash or near cash. In this study, this theory will help in analysis of SACCO abilities. In this study, this theory will help in analyzing SACCO's abilities and liabilities from its assets. The liquidity theory is relevant to this study as it guides SACCO by highlighting how much they are getting into their debt, whether their debt burden is heavy or light, and finally whether their financial situation is improving or not. And then the next theory was expense preference theory. Expense preference theory is one of the most employed in research. This theory was developed by Williamson in 1963 and later refined by Rees in 1974. This theory posits individual preferences of managers of a firm as utility maximizing as opposed to profit maximizing. It predicts that under certain conducive circumstances, such as separation of ownership and control, costly monitoring of managerial behavior, a lack of effective competition in input and output market or effective regulation in those same market. Managers spend more on other prerequisites than is consistent with profit maximization behavior. That's according to Krupas and Oswald, 1996. The first empirical work of the expense theory, that was the first empirical work of expense theory. Theoretical framework on financial behavior, financial institution was carried out by Edward in 1977. Using aggregated bank data of 44 banks in 1962, 1964, and 1986, and a total wages and salaries of the employees as an independent variable, he finds that the coefficient of 3 banks concentrated ratio to be positive and significantly correlated with both banks' total labor force and bank total wage bill. Thus, he concluded that expense preference behavior is a significant force that detracts from profit maximization in many banks. Other works consistent with this view include empirical work of Hanan, 1979, and Halmod, 1985, who found evidence of the expense preference theory in the banking firm. The theory is relevant to this study as it guides on how profitability of banks and SACCOs is taken in measuring financial performance. Though there are other alternative theories in this factor other than profitability are taken as measure of performance. So this theory will help us in profit maximization or profit measuring performance. Economic efficiency theory is the third theory that was used, which was stated that companies should achieve their output at the lowest possible cost per unit produced. According to this theory, economic of scale should be exploited to achieve optimal production. The theory focuses on 2 kinds of efficiency: allocative and productive efficiency. Allocative efficiency is achieved by ensuring that all firms in the industry charge optimum prices. In the banking sector, this will result in reduction of lending rates. The economic efficiency theory is relevant to this study as its guide in savings mobilization, which will enable SACCOs to create credit out of excess deposits. Hence, SACCOs will earn interest. Allocative efficiency theory will help in determination of lending rates among SACCOs, which will ensure unhealthy competition does not occur between them. High competition in banking is associated with instability. That's according to De Nicole and Jalal and Boyd, 2006. Productive efficiency is achieved when banks employ all their resources efficiently, producing the most output from the least input. That's according to Said, 2011. Productive efficiency guides both the lending and investing decision of financial institution, which include SACCOs. It would also involve investing in low-risk assets such as government bonds. And then we have the conceptual framework. We have liquidity and financial performance. Financial performance will be measured using return on assets, and then the liquidity will be measured using cash deposit ratio, credit deposit ratio, and liquid asset to total assets. And also we have thresholds that were set by SASRA, which is a regulator of SACCOs, such as capping external debt at 25%. See how SACCOs adhere to this, and the minimum statutory ratio of 15%. So the methodology that was employed is, in this study, explanatory recite design was employed. The target population was 83 registered deposit-taking SACCOs in Kenya that have been in operation for past 5 years. The sample size for the study was all 83 SACCOs that have remained in existence for 5 years. Census methodology was used in this study. Both primary and secondary data was employed. Multiple linear regression model were used to analyze data using statistical package SPSS and Stata. A pilot study was conducted to measure the research study reliability and validity. Descriptive and inferential analysis was conducted to analyze data. The data were presented using tables and graphs. And then on results, chapter 4, trend analysis was computed, and in trend analysis it reveals that there is moderate fluctuation of liquidity ratio for the 5 years as depicted in the graph in the table. That means liquidity was tested against performance. And then also there was descriptive statistics for liquidity, where there were statements on capping external debts at 25% in improve financial performance of SACCOs, and also observing liquidity at minimum statutory ratio of 15% improve financial performance. There was also a statement that liquidity is measured in terms of ratio of liquid assets to deposits and short-term liabilities, and then external borrowing is used as an indicator of liquidity status. So from this table, majority of respondents agreed with the statement of capping external debts as at 25% as it improves financial performance of SACCOs. 60% agreed with the statement that observing liquidity at minimum statutory ratio of 15% improve financial performance of SACCOs, and then 81% agreed with the statement that liquidity is measured in terms of ratio of liquid assets to deposits and short-term liabilities, while 72% of respondents agreed with external borrowing is used as an indicator of liquidity status. On the 5 scale, the average responses was 3.65 as depicted by the results, which means that majority of respondents were agreeing with most of the statement. However, the answers were varying as shown by the standard deviation of 0.74. These findings agree with Bang Hong of 2012, who undertook the study on effects of liquidity on performance of commercial banks. The study found positive relationship between liquidity and the existence and performance of banks. According to this study, adequate liquidity enables banks to manage its risk and therefore helping to sustain the confidence in operation of banking institution, which in turn lead to more patronage and more profit. And then respondents were also asked to respond on liquidity and performance in their organization. The respondents were asked to indicate whether their organization possesses adequate liquidity to meet their obligations as and when they fall due. Results reveal that 55%, as depicted in the table, indicated no, while 45% of respondents indicated yes. This implies that majority of SACCOs do not have adequate liquidity to meet financial obligation. This implies that most organizations experience liquidity problem. On another results that respondents, the SACCOs were asked to indicate whether the level of liquidity influenced the organization performance. Results reveal that 58% of the respondents indicated no, while 42% of the respondents indicated yes. This implies that most of the respondents do not think that the level of liquidity has significant impact to their organization. And then there was cross-tabulation was done between liquidity elements against financial performance. So when it was done, liquidity elements, that is capping external debt at 25%, improves financial performance of SACCOs. So as to check if there was statistical significant association between variables, the results reveal that the element and financial performance are not significantly associated, as depicted by chi-square of 2.88 and p-value of 0.422. And then also there was cross-tabulation of minimum statutory ratio on the element of liquidity, observing liquidity at minimum statutory ratio of 15% improve financial performance of SACCOs. And this shows that there was statistical significant association between the variables, between the element of liquidity and financial performance. The results reveal that the element and financial performance are significantly associated, which was depicted by chi-square of 14.92 and p-value of 0.02. Also further, we did cross-tabulation of liquidity element on liquidity is measured in terms of ratio of liquid asset to deposit and short-term liability and financial performance, so as to check if there was statistical significant association between the variables. The results reveal that the element and performance, financial performance, are significantly associated, as depicted by chi-square of 18.353 and p-value of 0.022. Further, there was cross-tabulation of liquidity element. External borrowing is used as an indicator of liquidity status and financial performance, so as to check if there was statistical significant association between the variables. The results reveal that the element and financial performance are significantly associated, as depicted by chi-square of 17.49 and p-value of 0.029. Further, we did a joint liquidity regression model of joint liquidity element, that is financial performance measured by return on assets and liquidity. And the specific model was that SACCO financial performance is equals to 0.027942 plus 0.01889 liquidity. The results presents the regression model used in explaining the study phenomena jointly. Liquidity element explains 66% of financial performance of SACCOs, as indicated by R squared, indicated in the table. This is supported by coefficient of determination known as R squared at 66%. That means that liquidity explains 66% of financial performance of SACCOs. Further results indicate that the overall model was statistically significant, as supported by p-value of 0.000. This implies that liquidity is a good predictor of financial performance. This is because p-value is less than 0.05 significant level. This was supported by F statistics, which was at 194.36, and the reported p-value of 0.00, which was less than conventional probability of 0.05 significant level. These findings agree with that of Omimo 2014, who analyzed the liquidity mitigation measures and performance of SACCOs in Kisumu County. The study found out that liquidity risk management approaches adopted by different SACCOs had a significant effect on their financial performance. The study revealed that SACCO adopted a more cautious position in their current liabilities to ensure that operating cash flow were sufficient to cover the short-term obligation entered by the firm. Further, the study reveals that debtors' collection period were longer to encourage voluntary membership, and consequently the SACCO were either unjustifiably constraining with creditors' payment period or were conditioned to do so. And then there was also regression model that was tested jointly on liquidity elements and financial performance, that is liquid assets to total assets, cash deposits ratio and credit deposit ratio against financial performance tested using return on assets. The model, that the results were that financial performance is equals to 2.952 plus 292 liquid assets plus 0.149 cash deposit ratio minus 0.087 credit deposit ratio. The results present the regression model used in explaining the study phenomena. Liquidity elements explain 42% of financial performance in Kenya. This is supported by coefficient of determination, that is R squared, at 42%. This means that liquidity and financial performance of Kenya are significant, which is indicated by p-value, which is at 0.00, which is less than 0.05 significant level. Results indicate that the overall model was statistically significant and supported by 0.00 p-value. This implies that liquidity is a good predictor of financial performance, being supported by F statistics of 15.909 and p-value of 0.00, which was less than conventional probability value of 5%. The hypothesis testing was tested, and then the hypothesis was tested using ordinary least squares regression. The accepted rejection region was that if p-value is less than conventional value of this one, then hypothesis 01 is rejected, but if more than 0.05, the hypothesis 1 fails to be rejected. The null hypothesis was that liquidity has no statistical significant effect on financial performance of savings and credit societies in Kenya. Results showed that p-value was less than conventional value of p-value 0.05%. This indicates that the null hypothesis was rejected. Hence, liquidity has no statistical significant effect on financial performance of savings and credit societies. And then on discussion, the study was to determine the effects of financial performance of savings and credit societies in Kenya. Majority of respondents noted that observing liquidity at minimum statutory ratio of 15% improves the financial performance of SACCO. Further, liquidity is measured in terms of ratio of liquid assets to deposits and short-term liabilities. Finally, external borrowing is used as an indicator of liquidity status. Regression analysis results indicated that there was positive and significant relationship between liquidity and financial performance of savings and credit societies in Kenya. Hypothesis results indicated that there was statistical significance relationship between liquidity and financial performance of savings and credit in SACCOs as depicted by the p-value, which was less than 0.05%. The findings agree with Omimo 2014, who analyzed the liquidity mitigation measure and performance of SACCOs in Kisumu County. The study found that liquidity risk mitigation approaches adopted by different SACCOs had a significant effect on their financial performance. The study revealed that SACCOs adopted a more cautious position in their current liabilities to ensure that operating cash flow are sufficient to cover the short-term obligations of the firm. Further, the study revealed that debtors' collection period were longer to encourage voluntary membership, and consequently the SACCO were either unjustifiably constraining their creditors' payment period or were conditioned to do so. Based on this finding, the study recommends that there is need for the deployment of efficient system to strengthen liquidity risk control fundamentals. SACCOs should also consider seeking professional guidance towards adopting policies on asset and liabilities management. The SACCO recommends that a similar study should be conducted in other financial sectors such as banking sector for comparison purposes. The study also recommends that a study seeking to examine the effect of other financial factors on financial performance of savings and credit society should be conducted. This would help to give insight to the SACCOs and other organizations as what other financial factors to consider to enhance their performance. Thank you.